Balance sheet statements. What is that? Hey taxpayers, welcome back to our YouTube channel. It's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. Today, we're back with another installment of our What is That series, where we break down financial terms and make them easy for you to understand. At Accounting to Scale, we're extremely familiar with the balance sheet statement because we provide this statement as one of 3 documents that we give to business owners on a monthly basis. We believe that analyzing your financial statements on a monthly basis will help you make key decisions to growing your business. So let's start right at the beginning. Balance sheet statements. What is that? A balance sheet statement is a document that reports a company's assets, liabilities, and equity. Essentially, it's what a company owns, who a company owes, and how much the owner has invested or retained in the business. The formula for this document is assets equal liabilities plus equity. The formula is intuitive because a company owns assets by either borrowing money or investing money. Starting with assets, they're listed in the order in which they can be liquidated. So, for example, how easily can these assets be converted to cash? Assets that can be converted to cash or are cash are considered current assets. Assets that will take longer than 1 year to convert to cash are long-term assets. Let's talk examples. Current assets might be things like cash and bank accounts, inventory, accounts receivable, prepaid expenses. Long-term assets might be real estate purchases, machinery, equipment, and furniture purchases, security deposits. The same goes for liabilities. Current liabilities are liabilities that can be paid within 1 year. Long-term liabilities are liabilities that will take more than 1 year to pay. Let's talk examples. Current liabilities might be things like accounts payable, credit card balances, unearned revenue, client deposits. Long-term liabilities might be things like mortgages, lines of credit, or other types of long-term debt. Equity. There are a few names for equity, such as stockholders' equity, stakeholders' equity, or just plain old equity. They all mean the same thing. Essentially, equity belongs to the owner or owners. It is the money invested plus the revenue the business has earned, less distributions that the business has given to its owners. When equity is negative, it doesn't look good. It means the owner has either over-distributed money or the business has been at a running net loss for a significant amount of time and there is no more capital from the owner invested in the business. Sometimes when equity is very small, it means that the owner or shareholder is likely distributing all of the profits within the same year, leaving very little to reinvest in the company. However, there are many reasons why a value could be the value it is, so stay tuned for a future video that we'll be releasing discussing ratios and key performance indicators. Subscribe to our YouTube channel right now to be alerted when that is released. The balance sheet is an invaluable piece of information, but it does have a drawback. The balance sheet is as of one date in time. So it's a bit difficult to analyze because the position changes very frequently. In fact, the only real way to look at the balance sheet sometimes is to compare balance sheets over time. Follow me as we now discuss the balance sheet of a fictitious company. So on your screen, you see a balance sheet for example company as of December 31st, 2019. Like I said previously, this is a snapshot of 1 day in time. The current assets of this company, which are assets that can be liquidated within 1 year, are cash, petty cash, temporary investments, things of that nature. They then have some fixed assets. These are long-term assets, land improvements, buildings. Each section of assets has its own subcategory and subtotal. The total assets of this company are $770,000. Looking over at the current liabilities next, these are liabilities that can be paid within 1 year. So as of December 31st, They owed this much on notes payable, accounts payable, wages, interest, etc. They also have some long-term liabilities, and similar to assets, each subcategory has its own total. Moving on to stockholders' equity or shareholders' equity, common stock is the investment the owner has made. Retained earnings are prior year's earnings that have stayed within the company and not been distributed yet. So as you can see here, the total assets of $770,000 equal total liabilities plus stockholders' equity. I hope you enjoyed going through this balance sheet with me. Subscribe to our YouTube channel so you can stay up to date with all of the information we're putting out. And all future, what is that? Installments. Follow us on LinkedIn, Instagram, or Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.